good, y'all? Let's go over balanced price ranges, or BPRs. So before we go over this, people get inverse fair value gaps and BPRs confused a lot. So I want to say this one thing. A BPR is always an inverse fair value gap, but an inverse fair value gap is not always a BPR, and I'll explain why here. So a BPR is a highly probable PD array referring to a situation where price has quickly traveled both up and down, providing both buy-side and sell-side delivery that have overlapped in the same relative range of price, thus creating a highly resistant state of balanced delivery and price. I know this sounds confusing, guys, so just wait, let me get into it. BPR is indicative of institutional players quickly repricing out of a range, thus trapping traders in that range of price prior to the formation of the BPR. So if that made absolutely no sense to you, and you're more of a visual learner like me, I'll explain it right now. So we see price quickly traveling up here in this candle, offering buy side, but it left a fair value gap in this range of price. And then with this candle, we see price quickly traveling down, leaving a fair value gap, but it's overlapping with this bullish fair value gap. So these actually cancel each other out and create what is called a balanced delivery in price. That's why it's called a BPR, a balanced price range. So these are essentially inverse fair value gaps on steroids and offer a very precise entry point, and they're a great indication of a reversal. So the average of the two fair value gaps becomes the level of support that you will use. So the reason why they're more powerful than inverse fair value gaps was explained in this second paragraph, and I'll explain that more thoroughly now. So what a BPR is really indicating is institutions quickly pricing and repricing out of a range. So as we went over, we quickly went up into this range here, and then we consolidated. When we consolidated, we trapped all these longs, all these orders, and then the institutions quickly priced out, trapping all these longs. So when we come back into this balanced price range created by the balancing of the buy side delivery into the range trapping the longs and the sell side delivery out of the range, when we come back into this support area, it's actually these trapped traders trying to sell at the best price they can to get out of their trapped longs. So essentially, just by knowing what constitutes a BPR, you can see how it's different than an inverse fair value gap. It's nuanced, and it actually tells a story of what institutions are doing and how they're trapping orders. That is why I like these better than inverse fair value gaps, and these are probably my favorite PD array. So how can you identify them? A BPR can be identified by two unmitigated overlapping fair value gaps, one bullish and the other bearish, or vice versa. BPRs tend to occur after a brief period of consolidation following liquidity being taken. So basically the average of these two fair value gaps is going to be used as the BPR, or the level of support. This is not the best example. Sometimes you want them to be bigger and kind of overlap more thoroughly, but we'll go into the examples later. So we already kind of went over why they're important and the story they tell, but again, the formation of a BPR alone implies a directional bias in price to go the opposite way of the trap traders, similar to an inverse fair value gap. BPRs are highly resistant, and if traded back into, usually see their CE levels respected. So I really want this to make sense to you guys because it's really important, so we'll go into a couple examples. Alright guys, so let's go over a couple examples of BPRs. You can pause this video real quick and try to find some yourself, but I see a couple here. So we have a bullish one right here, and I'm simply going to take the averages of the two fair value gaps created. As you can see, we had sell side delivery into this range. We consolidated a bit, and then we had buy side delivery repricing out of the range, trapping these shorts. So we take the average of these buy side and sell side fair value gaps to create a balanced price range. And as you can see, it is highly resistant. We could have taken a trade at the CE of the BPR and targeted a buy side level of liquidity. So I want to show you guys this one right here. We had our sell side delivery or consolidation. We had our buy side delivery, trapping shorts in this range. As you can see, the bodies of these candles respected the midpoint of the BPR, and then we went up. Here's another good bullish example I found. So guys, these are great indicators of directional bias in the market and how institutions and the algorithm may be trapping traders in one direction in order to get to their desired liquidity levels. As you can see, it's highly sensitive, and the midpoint is often respected much better than fair value gaps or inverse fair value gaps. So I hope you guys liked the video and you understand BPRs fully now. This is one of my favorite PD arrays. Not only is it highly resistant and highly probable, but there's a story being told And it's your job to not just simply see them, but understand that story.
Yeah, hello.